Hey everyone. This week I'm going to focus on the housing market and how it's affecting commercial real estate. Now, like everything else, home sales are being influenced by the conflict in the Middle East. Since the onset of the conflict, oil prices have surged, climbing above $100 per barrel, and that, together along with tariffs, is sustaining inflationary pressure on the U.S. economy. As a result, the Federal Reserve chose to hold rates flat in March, and Wall Street expects the Federal Reserve to stick with that strategy through the end of the year. Prior to the Middle East conflict, 2 to 3 rate cuts were expected this year, but since the onset of the conflict, the Fed outlook has varied widely. As of late last week, there was a 72% probability that rates will remain flat through the end of the year. As a result of these forces, the 10-year Treasury has fluctuated, ranging between 30 and 50 basis points above where it was at the end of February. And that, in turn, has pushed the 30-year mortgage rate up by nearly 50 basis points to 6.46%. For home buyers, that 50 basis point jump has pushed the mortgage payment on a median-priced home up by about $120 compared to late February. Now a home payment is about $3,090 per month. Single-family house prices have nudged 0.2% higher over the last year, and sales activity has remained stable near 4 million houses per year on a seasonally adjusted annual basis since the Fed began hiking rates in 2022. To put that in perspective, that's about the same level of home sales activity as we experienced during the pandemic. Now, slower home sales influence a variety of commercial real estate property types. For retail, the slowdown has dampened furniture sales, which were down in February by 8% on an inflation-adjusted basis compared to last year. Building and gardening sales are up about 1.2% compared to last year, but they were down for the last 3 years. And naturally, the slowdown in home-related product sales weighs on retail space demand to a limited degree. And that flows through to industrial space as retailers warehouse fewer home-related goods. But of course, the most significant impact of rising mortgage payments and slower home sales is on multifamily properties. And since the end of 2021, median home prices are up by more than 10% to about $420,000. And in conjunction with the higher mortgage rates, the monthly payment on a median-priced home has risen by more than 50% since the end of 2021 to $3,090 per month. By comparison, in that same time, the average apartment rent in the US has increased by only about 13% to $1,854 per month. The spread, the affordability gap between the average monthly apartment rent and the monthly payment on a median-priced home, including the principal, interest, taxes, and insurance using a 10% down payment, has widened to $1,236. And that spread remains a significant barrier for first-time homebuyers. As a result, more households are choosing to rent for longer. In the last 15 years, the median age of the first-time homebuyer has increased from 30 years old to 40. And that trend is supporting elevated apartment renewals, which at the end of 2025 stood at 56%. So while higher interest rates are obviously not a welcome sight for commercial real estate investors, for multifamily properties, they do offer the silver lining of increased renter retention. In addition, higher interest rates will further restrain multifamily construction as the cost of construction financing rises, and that will be compounded by the combination of tariffs and elevated shipping costs that are driving the cost of construction materials higher. Multifamily construction starts are already down by 72% compared to their peak in 2022, and the number of units under construction is down by 51%. So while the conflict in the Middle East has put upward pressure on interest rates, adding another wrinkle to investor underwriting, higher rates have also favorably influenced the long-term multifamily supply and demand balance by restraining additional apartment construction and the migration of tenants into homeownership. Those are favorable trends for the long-term multifamily investment outlook, and that's a key for investors who keep their eyes on the horizon.